Good afternoon and welcome to our final episode of How May I Help You for 2024. So, one of the big questions that I have been getting is I owed taxes this year, or I paid more in taxes this year in the past. Why? A couple reasons for this. Interest income with interest rates at 5% or above in 2023, you earned a lot more on your cash than you have in the past. I actually just met with a client today, and that was what we found out is that her high yield savings account paid her about $9,000 more in interest than what she's received in the past. And so that made a significant difference on her tax return. Also, remember with taxable brokerage accounts, you invest cash on which you've already paid income taxes, such as money from your paycheck, or just assets that you inherited or assets that you've had for over the years. However, you may still owe taxes on future income or growth from these investments. For example, dividend income is taxed in the year that you receive it. Even if you don't take any distributions from your account, if you receive taxable income, you still have to pay taxes on it in the year that you received it. Even regardless if you sold the investment, because remember, this is dividend income, while the growth on capital gains is taxed when you sell your investment. So how are dividends taxed? Dividends are regular payments made by a corporation to their shareholders as a distribution of profits. And while there are many different types of dividends, the most common dividends are paid quarterly by large blue chip companies, for instance, like Microsoft. The amount of tax paid on dividend income depends on whether they are qualified or ordinary dividends. These classifications are made based on the length of time that the underlying stock has been held, and the tax owed depends on the investor's tax bracket. Qualified dividends are payments made by stocks that an investor has held more than 60 days during a 121-day period that began 60 days before the ex-dividend date. Preferred stocks must be held for 90 days or more during a 181-day period that begins 90 days before the ex-dividend date for dividends to be qualified. All of this is reported on your 1099, whether it is a qualified or an ordinary dividend. But these dividends are taxed at long-term capital gains rate. So if it's a qualified dividend, you're going to be taxed at possibly a lower tax rate than your ordinary income. Whereas ordinary or non-qualified dividends are made by stocks that don't fit this criteria, and they're taxed at the ordinary income rate. This is also why 1099s take a little bit longer to get out to you than what they used to, because we do have to make sure that the 1099s are reporting ordinary income or qualified dividends correctly. But it is reported on your 1099, and your CPA can answer any questions you have on that, or your financial advisor. Qualified and unqualified dividends are both reported on, like I said, the Form 1099 dividend, and must be disclosed on Form 1040. Investors earning more than $1,500 in ordinary dividends may also need to fill out a 1040 Schedule B, but once again, your CPA can walk you through this. The next question is, what is capital gains and when do I pay it? Capital gains tax is charged on profits made from the sale of an investment. In other words, if you sell an investment for more than what you paid for it, you may owe capital gains tax on your earnings. The exact rate you'll pay is determined by your overall income level and how long you held the investment before selling. Unless you're required to make estimated tax payments, you'll pay capital gains tax when you file your income tax return. What's tax loss harvesting? Tax loss harvesting is when you intentionally sell securities at a loss to offset capital gains. You can offset all of your capital gains and losses during the same tax year, plus up to $3,000 of ordinary income if you're single or married, filing jointly up to $1,500 each if you're married, filing separately. You can use this strategy to lower your tax liability when rebalancing your portfolio. Tax loss harvesting only applies to taxable brokerage accounts. It can be complex, but it does offer a sophisticated way to turn market volatility into tax savings opportunities. It's important to have a financial plan in place, and part of that financial planning process is to look at tax loss harvesting, look at income, looking at capital gains, and managing that portfolio for you. If you don't have a financial plan in place, reach out to us here at Full Circle Financial and let us help you put one in place, and maybe that'll make tax season next year a little bit more understandable. As always, we are available here for any questions or concerns that you have. We hope you've enjoyed our 2024 How May I Help You series. Don't forget to look at the YouTube channel and look at all of our How May I Help You from the past. Have a great day.